today we're going to talk about terms and trends in VC financings, and then we're going to come back another day and we'll talk about sort of negotiating price. So this is really to give you the landscape of the terms that are a lot of lingo, a lot of shorthand that will give you the tools and sort of the building blocks as you think about financings and to begin to understand. Again, a lot of this, you will have a lawyer or an advisor who can help you, but really the founder or the person running the company really needs to understand the terms and how they interplay with each other and how they may interplay with the growth of your company and where you are. So I think we're going to go through, it's actually a fair amount of material, so if we don't get through, we can actually even tack on one more session, because we want to make sure that we have time for your questions. So feel free to interrupt as we go. So I'll just do the intro. Oh, sorry. So I'm Jen Berendt again, for those of you who, some of you are new faces, a lot of people the same. I'm a partner at WilmerHale, and I run our emerging company practice in New York. We focus on tech and life sciences companies here and do a lot of outreach in the community. I know Sam and have been teaching this seminar here and like working with you guys.
Darren Murphy with Jen, WilmerHale, new emerging company in corporate sphere. I've done a lot of venture financings with Jen, so I feel like I know something about the area, although it's strange for me to be in a room where so many people are have so much more education than I do.
Right.
So, a little intimidated.
So, oops. Okay. There we go. The venture capital financing. So this is just a basic. So what is a VC financing, a VC transaction? What it is that it's a type of private equity transaction. And all that means is that someone's taking money that they have, you're not doing a public offering, and they're investing it in a company. And the idea is that it's early stage, it's high potential growth companies, and the VC investors are looking at this as they're going to make a return. And that return will come either through an IPO, an initial public offering, or through a sale of the business. And so it's different than, say, a grant, which doesn't expect any return, or a loan, which we talked about a little bit, a convertible note, but just even any sort of loan that is thinking about getting a return in terms of interest or some other fixed payment. This is really, they're in for the ride, and then they have the greatest risk. And in general, they're made, for cash, and you give them shares in your company. So there's a percent ownership, and they own, they give you money for that percent ownership. And that's the fundamental structure, and that's really how most businesses get funded, through some sort of early stage investor, which is frequently venture capital. And so, and most type of growth companies will need venture capital financing at some time. Your types of companies that need a lot of outlay and have a huge high risk early on are sort of prime examples of VC type backed companies, as you know. So I'll toss it over to Dara, and I'll jump in as we go along.
So before we get into the technical aspects, things I always talk about with founders are, the key business drivers behind, you're going out to get money. And I know from working with a few founders, it seems like any money would be good money at times, especially when you have a lot of time put into a company. The things to think about when you're going to look for capital are that these people are going to be your bedfellows for the long run. And if you truly believe in your idea, it's sometimes better to take less money from better people. People in the industry generally will be with you for 9 or 10 years, depending on your platform. It's a much longer time horizon than in the tech sphere, where it's 4 or 5, 3 or 4. You're either Twitter or you're not. To prove out a drug or to prove out a new technology, obviously takes a lot more time. And so it's important to know the people you're going to be in bed with for this long. And if you truly believe in your idea, it's something to think about, and it's something that I find people, it's not even when you say it to them that they actually take that on board and go forward with it. once you do find an investor that you like and that you're willing to give a part of your company to and take on as an advisor and as someone who you're going to have basically a strategic relationship with for a long time, what you'll first end up doing is you'll start talking about terms, and you're not going to be knee deep in drafting. Obviously, you'll help and a law firm will help you draft a term sheet that has 2 or 3 pages, very high level, 1-sentence descriptions of agreements that are going to be a lot more detailed, and that's what feeds in then to the more substantive agreements that we will draft, and that's what we have obviously on our graph here. It's important to note with the term sheet that I find a lot of people will hand the lawyers a fully negotiated term sheet sometimes. And if you've done it a few times, that can be a good way to go, but it's a great idea to get your lawyers in early. Obviously, it's a shameless plug for lawyers, but you do need the advice because it really will help shape what the whole round will look like early on. And if you do have investors, it can be a good idea to get a meeting early, talk about how you're going to negotiate, because obviously, most of the time the term sheet isn't binding except for the confidentiality provisions and the agreement not to go looking for other deals, called a no-shop clause. But you don't want to end up retrading on points. It makes you look bad. And so if someone's going to invest in you, your word is obviously your bond, and it's not a good way to start a relationship if you start retrading on things that people think are already agreed. So the main documents in the transaction are the certificate of incorporation. Obviously, anyone who has an entity day one already has a certificate of incorporation. It's your constitution, it's your charter, it's what governs the whole entity and allows you to be a separate entity. And in the certificate of incorporation is where venture capital firms will put all their protective provisions, and we'll get into that in more detail later, but that's kind of where they protect themselves, that's where they really define the core rights. And then most of the things are kind of ancillary. The real protections they have are going to be in the certificate of incorporation, and you'll negotiate that, and it ends up getting filed before the money comes in, normally like hours beforehand, but it's when everything else is keyed off, basically. So, as you know, the venture capital transaction is normally a sale of stock, and so what you end up entering into is a stock purchase agreement. If you think about all these other agreements that you've entered into when you start a company, you'll have your own maybe restricted stock agreement. Some advisors will have a stock option agreement, and so the stock purchase agreement is somewhat akin to that. It's an agreement to sell shares. Obviously, by necessity, it's a lot more detailed. What you really need to be concerned about as a founder with the stock purchase agreement is what you're saying your company looks like. And these are representations and warranties. You're going to tell the investor in this agreement through 20 or 30 paragraphs, this is what the company looks like. These are the outstanding shares. Have we ever been sued? Yes or no? Our IP is intact. We have made sure that all of our employees have signed NDAs and we all own our IP. And this is really how an investor gets two things. First of all, gets to really look inside your company while you're negotiating these terms. And then when you sign the agreement, it's not swearing an oath, but you're setting in stone what your company looks like. And venture capitalists aren't in the business of suing people, but if you were to lie about your company, this is how you get sued. If you were to misrepresent what it looks like, or you could even rise to the level of fraud. Not that anyone would do that, but this is where the diligence comes in, and this is where you really show them what your company looks like. And that's kind of the stock purchase agreement. One, it's mechanical and sell your stock, but two, it's diligence, and people like to use the term "come to Jesus." This is where you'll really have to tell them, these are the bad and the good of our company, and this is the issues you need to worry about if you're an investor. So the next document is, and this will probably bore you to tears because it does with me, and I do this every day, it's the certificate of incorporation. As we said before, the real meat of the transaction ends up here, and the rights and the burdens that the parties are going to have ends up in the certificate of incorporation. We've detailed some of the main things you need to think about.
Sort of do this back.
Yeah, I think so. It starts.
Should we do dividends first?
Yeah, sure.
No. Alright, we're just going to flip that and get back. None of this. Okay.
So, the section on dividends is important because you can have various types of dividends, and a dividend is a right. Is the company will say every shareholder gets 6 cents, every shareholder gets 2 cents, I'm going to say with major public companies, dividends are usually optional, right? If they want to, Apple recently did a dividend and it was a big thing, right? If they have a lot of profits on the balance sheet, that's what they're for normally, and that's what you see happening is if you have profits on the balance sheet, you want to give the shareholders some of that money, you give them a dividend. In the context of your companies, which are most likely going to be loss-making for a long time, the dividends are a little different. In the case of venture capital, what they use the dividend for is to sometimes guarantee themselves a return. So you can have different types of dividend. You can have a dividend that is only payable if the board decides to pay it. And in the normal course, as a startup company, you're almost never going to grant a dividend. Like, in fact, I've never seen it, never even heard of it. There are two other types that you need to think about, and they are accruing dividends and cumulative dividends. So what can happen is, even though the board doesn't say that anyone gets a dividend, by right and by the transaction structure, your investors will have a right to a payout that starts to accrue. What will happen is every year that the board doesn't grant a dividend, there's still money that is accruing for them, and it's in their account basically. And it could be 6 cents on every dollar, it could be 6% on the value of every share, but basically they're locking in a return for themselves if there is ever an IPO or if there's ever an M&A, they're guaranteed this money on top of everything else they'll get. I'm drawing a blank on cumulative dividends.
Cumulative is sort of a similar concept in that you have sort of a fixed amount, but it doesn't, it's only sort of per year, so that if you declare dividends, you will have, so you will get that 6%. The accruing and cumulative is that it's this concept that, and it's going to keep building, and then the dividends are going to you're going to have to pay dividends on unpaid dividends, right? So it's sort of like a loan, not an accruing loan, so that they go into the principal. That's all very bad for you, and so you really want to try to not have any sort of accruing or cumulative dividends. And because you know that you're going to need all that capital to keep reinvesting in the company.
And there are two types of dividend as well. There's a cash dividend that's always accruing that you have to pay out as money, obviously, at a certain point. There are also stock dividends, and so people can get 4% of one share every year, and over time, if you have 1,000 shares, that can amount to a number of shares that they would get. So it's kind of dilution to you later down the line. Even though they only hold 1,000 shares today, they're getting 0.04 of one share every year, and so later on, what will happen is you'll convert, you'll sell, and they get those shares, right? They've never been paid out or anything, but if it's 1,000 shares and you go 2 years, you're going to end up having to give them 80 shares on top of it when you do sell the company. So they're the two types of dividends, stock and cash dividends. The liquidation preference comes into play more. With dividends, you sometimes see them and you sometimes don't. You don't really see them in the tech space, but I've seen them in one or two biotech companies that have recently done IPOs. And it's just more money in the investors' pockets and less money in your pocket. So obviously, as Jen said, it's something you want to avoid. The liquidation preference, basically investors who, especially preferred stock investors, they want to guarantee a return, right? So they want to make sure that they are entitled to something over and above what everyone else is entitled to. So when you sell your company, if the company isn't worth what they've invested, or if the company is only just worth what they've invested, they're entitled to their money first, and if you don't get anything, too bad, right? So let's say they've invested 40 grand, and you sell your company in 2 years for 40 grand, they'll get their $40,000 first before anyone else gets anything. And that's the liquidation preference in a nutshell.
And just so you know, that's important for protection of them as well. Because let's say in this case where you have $10 million comes in and that's for 50% of the company, if they don't have a liquidation preference, the day after they come in, you can say, well, I have 50% of the company and I have $10 million in the bank. 5 million sure sounds good. I'm going to shut down the company, take my 5 million, give them 5 million back, and I'm moving to Bermuda, right? So the problem is that the liquidation preference incentivizes you to put all that money to work to grow, as opposed to sort of taking it off the table because they only own a certain percent of the company. And so that, if anything, you almost, I mean, it would be very, very rare not to have a preference where they get their money back. If nothing else, just to close that loophole of sort of bad incentives.
And there are two types of preference. One is called non-participating and one is called participating. Non-participating is that they have this right to get their money out first, okay? And they have this right to get a certain percentage of their money out first sometimes as well. In non-participating, they can't get their money and they can't double dip basically, right? They can't get their money out and then transfer to common and take part in the upside. They can only get a set amount back, and that's they can either get their 40 grand back, or if the company's worth $1 million, they can not get their 40 grand and they just participate in the upside like everyone else. With participating, they get to get their 40 grand back, and then they can convert, and then they get some of the upside in the $1 million that keeps their company suddenly worth. So they get to what's called double dip basically. They get their money back plus the upside, or you treat them like every other shareholder and they just get upside. And it kind of comes down to negotiating power, and it's more money in their pocket at the end of the day, and that's money in yours.
So typically, you can try to fight participating preferred because it's been a much better market. Not just tech, but life sciences as well. As you know, the IPO market's been open, and whenever the exit market is open, that trickles down to making terms better for all levels of capital, right? So what you're seeing now is that life sciences companies have more strength than they would normally. Sometimes if you have to, if you find investors that insist on participating preferred or are very aggressive, or maybe your product isn't as strong, or whatever the reason may be, you sometimes can have participating up to a cap. So you could say, look, you can't get your money back and then just participate infinitely. You either, if we are really a home run, it's just annoying that you get your money back. And so maybe you get up to 2 times your money back. And then if you're really going to get 2 times your money back, we'll just all share it. So that's some way sometimes we sort of bridge the gap. So that you're trying to guarantee them as much of a return as possible, sharing as much return as possible. But if it's a home run, you guys are all together. But in general, I think you should be able to get non-participating in this market, where they either get their money back or they just participate for that. And that comes up, for example, in that case where you have the $10 million for 50% of the company. You could see if you sold the company for $15 million, they'd rather take $10 million back than get 50% of the company, which would be $7.5 million, right? That's where that comes up, right? So once you get to $20 million that you're selling the company, then they're indifferent, right? Then one or the other. So at $30 million, if you sold the company for $30 million, they'd rather take 50% of the company, so they would get $15 million, you would get $15 million. And a participating preferred, what would happen is at $30 million, they would get $10 million back. Then you would get $10 million and they would get $10 million. So they would end up with $20 million and you'd end up with $10 million. And so in that middle scenario, it's a huge benefit to investors, right? And it's just coming out with that.
The next deal point is anti-dilution provisions. Basically, the investors don't want a scenario where they give you $2 million for 20% of your company tomorrow morning, and then you turn around and you issue a ton more stock. So their $2 million wasn't worth 20% of the company, it's actually now only worth 10%, right? Their shares have been diluted and they own less of the company. So what they do is they protect themselves in one of 2 ways. And the first way is the way we normally always see, which is weighted average. And in layman's terms, basically, if you issue stock at a price lower than you previously issued the stock, so you give Series A preferred stock to investors at 50 cents a share, and tomorrow you turn around and sell it at 25. There's a very convoluted equation as to how they bring you down, but it's a very fair way, right? So it just takes into account how much dilution they have suffered, and it evens it out accordingly in a fair manner, and it kind of gets them back to the position they would have been in had you not taking this action and kind of splits the difference. The full ratchet is a lot more punitive. All their stock, basically they'll get twice their stock. For even if you issue one stock share. I'm not explaining this correctly. Sorry, I always get tripped up. I'll let you take it over.
That's right. Yeah. No. So that in his example, when you have 50 cents a share, let's say you sold you sold $10 million of stock at 50 cents, and then you sold let's say you had a strategic investor, and that strategic investor says, okay, I want to come in. I'm only going to give you 100,000. I'm only going to pay you 25 cents, but it's Pfizer, and you say that's worth it. Well, all of that $10 million shouldn't all of a sudden be at 25 cents a share, right? I mean, it's just a huge advantage to them for just a small issuance. And so a weighted average, and that's full ratchet, right? So they get, even if you issued one share at 25 cents, their stock goes from costing 50 cents to 25 cents. And that's hugely bad for the company. In weighted average, it says, look, you gave them a little tiny bit, whatever, 1% is at 25 cents. So instead of 50 cents, it probably is at 49 cents, right? So there's like a little bit. So it is really a compromise position, and very rarely do you have to do full ratchet. The only time you have to do full ratchet that I've seen in your stage is that if you really push someone up to a high valuation, like let's say you say, my company, I know it's just an idea, but my pre-money value is $10 million. And the investor says, I really think it's worth $6 million. And you say, look, it's worth $10 million, and my next round is going to be at 20. That investor could say, look, I'll give you 10, but if your next round's at 6, which is where I think it should be, I get full protection, right? And that's the context where that makes sense, right? They're sort of giving you the benefit of the doubt. Fine, if it's 10 and you hurdle it and you get to 20 on your next round, you win. But if you go to 6, you lose, right? And I don't suffer that risk. And that's sort of the scenario where giving in that full ratchet may make sense. And so again, part of this is to give you the tools and how to negotiate. And sometimes that's a useful tool to negotiate if you really care about that early valuation and getting people over. Oh yeah, so now we can go back to. Nope.
So we're going back to slide 5.
Can you move it back one?
So we spoke about all these kind of scary provisions that aren't helpful to you and they really protect the other side. The next provision, pay to play, is actually beneficial to the company in many scenarios. What a pay to play provision is that if you raise $1 million tomorrow and you need more money in a year and you have 2 investors tomorrow, you don't see when there are numerous investors, but basically if you raise $1 million tomorrow and then in a year you need to raise more money, and one guy that says, no, I'm not putting up any more cash, and the other guy that says, no, I will put up some cash, or you can find cash elsewhere. The guys who don't put up their money the second time around, they lose all of their rights. They go back to common stock, they lose the benefit of their bargain. And this helps you because if you can raise more money from one of your investors or from an outside investor, next time, the guys that were in last time have to come up with the cash, basically. So in your business, which is obviously very cash intensive, it's very helpful to know that if you can raise money again from one of your investors or someone else, that everyone else has a huge incentive to re-up in their investment. And it's only if they take something drastic changes or something really goes wrong that changes your risk profile that an investor is really going to say, I already gave $1 million, why would I give another $1 million? I already gave $5 million, why would I give another $10 million? So it's really beneficial for you to have a pay-to-play provision. And it's something, if you're going to give up other terms like this full ratchet, you should think about it, and hopefully if you have good lawyers, that'll help you think about these are things we can get for giving up these other more punitive provisions. And a lot of times it can be worth it.
And sometimes this really comes into play when you have more than one investor. So let's say you know that you're going to need $40 million to get really to FDA approval, but you're going to raise 10 now, and you're going to raise that 10 from 2 different parties. And one party is a little bit worried about the other party's seriousness, right? So maybe it's like an $8 million round and a $2 million. One party's putting in 8, one's putting in 2. And the guy who's putting in 8 is really worried that the $2 million is just along for the ride and isn't going to keep putting in. Then sometimes for them, they will say, look, I'll either take all 10 because I'm here for the long haul, but if he's going to take a portion of mine because you want to have diversity of your investors, they don't keep putting in, that's not fair to me. because, you know, they're sort of just buying themselves a lottery ticket, and they're really sort of piggybacking on my capital. And so you see it come in frequently. It's actually extremely uncommon in the tech universe, and, you know, not uncommon, which people hate, so I was going to say, it's not a total shocker if you see it in life sciences. You know, in fact, it's fairly common. And a lot of times that does depend on the investor dynamics. If you really have a strong, you know, one of like the top tier VC funds, and they say they don't want this, and the investors are comfortable, you know, most of the time you don't want to force it because they know that they are going to have to be there. But it is something, you know, again, in the mix of provisions, that is helpful, especially if they've talked you down. So you want $10 million and they're only willing to give you 5, or you want 20 and they're going to give you 5, right? So you really want to say, look, I know I'm going to need more money and I'm willing to sort of take it down. You're not getting the valuation risk, because you'll get, you know, if we lose it all, you're not fully risked on the valuation, because they are taking the valuation risk, but they're sort of taking that off. Then you could say, look, if you don't come in, that's not fair, because I'm going to have this huge overhang on my company. So that's where that comes in.
I think sometimes pay to play is, I mean, it's kind of setting in stone what the economic incentives would be normally, unless something changes drastically. Because if you think about it, you put up $5 million to invest in a company tomorrow, and then in a year they come back knocking on your door and say, we need another $5 million, and things they look the same, we're going to be very successful. You can not give them the $5 million and watch, you know, be diluted down and someone else gets to play and piggyback on the money you've already put in, or they don't get any other funding and the $5 million you already put in is dead, right? It's gone. So they're kind of, if you're an investor, that's what you see coming down the line if you're not going to put the money in anyway. So it's helpful to have it there, but these are the things, I mean, these are the economic incentives that are kind of inherent in investing anyway.
That's right. And it's a bad signal. So the reason that it's important to companies is that if you have your 5 investors and 3 of them don't want to give you more money, it's very hard to get other investors, right? So all investors always have pro rata rights to keep investing. That's something that we'll talk about later. And so if they're not taking up their pro rata, that makes it harder for you to raise money. So this is sort of compensation for that. So those investors are saying, I'm not backing you anymore. You still believe in your product. And so you then have a hard time raising money, but at least you can go to new investors and say, look, those 3 guys, they're just short on cash. They have different strategic initiatives. But you don't have to worry, they're not taking up part of your pie, as we were talking about. They're going to be sort of reduced down, so they're sort of a lower piece of the pie.
And so the next item are redemption rights. And a lot of the terms actually in the VC, in the standard VC investment package you'll see are somewhat draconian, and honestly I think some of them we've gotten rid of, and redemption rights are one of those classes of things that should, in my opinion, be done away with, because what a redemption right is, it's the right of your investor to come back to you in 3 or 4 or 5 years and say, I'm done, give me my money back. So there are some protections in Delaware law about, that protect you from having to pay money that's going to bankrupt the company. But if the company is marginally successful, you have the money on your balance sheet, and obviously to give $5 million back in 4 years' time is going to be a big thing. And say you could give it back, you don't want to do that, right? The last thing you want is have your investors knock on the door and say, make me whole, give me my money back, and walking away. And part of the reason I think it shouldn't be included anymore is that, if you hear about venture capital firms that are doing this all the time, that are knocking on founders' doors saying, we want our money back, we want to walk away, the chances of more founders going to that investor and saying, hey, I'm a good founder and I love you in my company, even though I know there's a huge chance I'll come back in a few years and want my money back, it's slim. It's not good for the VC, and unless something drastic goes wrong, it's unlikely that it's ever going to be used. And so, I think you could almost include it if you had to, knowing that the chances of someone actually exercising it due to reputational risk are slim.
No, that's exactly right. It's very rarely used. It's a hammer, it's a tool. I think it arose back when I think first of all, it's sort of sometimes in private equity, it might be used, but in venture capital, it really is not. It makes equity look a little bit more like debt. It's sort of like having a maturity, but as Dara said, you don't have the overlying bankruptcy risk. And so it's a little bit of a downside protection. And again, it's some VCs are more worried about downside protection, some only worry about the upside. it's a bit of an East Coast term, as they say. The West Coast doesn't really use this as much because they don't worry as much about downside protection, both in tech and life sciences. But I have to say, that being said, it's very common, and I wouldn't really get too worked up over it. You usually try that where you, what you try to do is push out that 3 to 5 years as late as possible, so 5 or 7 years. And then you really try to say it's only original purchase price. So basically, if you're walking out on the money, then you know, company, all you do is get to walk away with your money because you're not in until the end. And I would say that's usually what happens. Is that, you know, they can negotiate it to that to a narrow. Sometimes you can also do, say it's over 3 years, so it's less of a hammer. So right, they get a third back in year 5, a third in year 6, and a third in year 7. So there are ways to sort of legally go back and forth, but I agree with Dara, it's a little bit of a dinosaur. You know, VC is like all herd mentality, don't want to give it up, because if they give it up and you're the 1 in 100 that they would like to have used it, then they feel dumb. And so it sort of tends to be in there no matter what.
And the thing about a lot of these terms are, you know, we can speak about them in the abstract, but it's, again, it's like who you're going to get into bed with for the next 7 or 8 or 10 years. I mean, you're hopefully going to have a choice when you're taking out money, or if not, you're going to like the person that you want to take the money from, and you can talk to their other portfolio companies and really get a sense of what they'd be like. And if you trust the person, you know, it's kind of a business risk, and we can talk about it in the abstract, but it'll obviously be something for you to weigh up when it comes to choosing your VC. And if you trust them, I mean, as lawyers, we always say insure yourself, but sometimes you can get comfortable with a lot of these terms, knowing that the person's a good person and they're not going to treat you in a punitive manner for no reason at all.
Is there only how you deal with anti-dilution rights? If you have too many anti-dilutions, if you need to raise more money, yeah, you only dilute your own shares, and you end up having nothing. And how do you deal with those things?
So I think there are two things. So first of all, dilution technically really means like at a lower price. So it's this very and that's why, you know, we don't think so much of the pie, right? It's this very classic, you'd rather have, you know, 1% of $1 billion than 10% of $1,000 problem, right? So theoretically, or, you know, and really how everybody thinks about it, the more money coming in is helping the value of your company increase, right? So if you sold your company today, and let's say you got your pre-money valuation of $10 million, you would have 100% of $10 million. But by taking in $10 million and a $10 million pre-money valuation, you're hoping that you're going to have 50% of $50 million. Now, let's say at your next threshold, it's worth $50 million, right? And you own 50%, and you take in, you know, another, you know, 10 million for 50% of your company. So now you only own 25% of your company. You're only doing that if you think, again, that 25% will be worth more, right? And so it's never dilutive just raising money if the value is going up. It only becomes dilutive when you now own 25% of something that's worth $5 million, right? And so it goes down. And so yes, you might not have percent protection because, you know, it's going, you know, you're selling more and more shares, but you're not necessarily diluted, right? You might still be making more and more money. That being said, so that's sort of the technical way to think about it. For management, frequently in life sciences companies, because you have to raise so much, the people still working there will frequently get options, you know, more and more options, and they will get equity that way. So the people that really get diluted are the scientific founders who aren't working for the company, right? So maybe they started with 5 or 10% of the company, and then they're just sort of along for the ride, but they're not putting in more and more effort. The management tends to get more compensatory, and so that they, you know, don't get diluted all the way down to 1%, and they get to stay at 5 or 6%. And that's how you solve for that problem. But yeah, you know, especially in big technologies that could need $40, $100 million, you will have a smaller and smaller percent, but it doesn't mean you make less and less money.
My question is for the early investors. Do you give them also in the dilution rights?
So that's what Dara was talking about. Again, only if the price is low. What they get is they get to participate at the next round. So keeping their 5% or 10% stake is important. They don't just get it, they have to buy into the next round. And they always will negotiate pro rata participation rights. That's very fundamental to any investor. That if the company is doing well, or even if it's doing okay, but they still believe in the exit, they want to make sure they're in round after round after round. Sometimes seed investors can't do that. And they do get diluted down, but that's just how they make their money, right? So it's just a different economic decision for them. So some seed investors only can put in $500,000 or $1 million, and they just know they're going to get diluted, but they're spread thin enough. So that's just their economic modeling. And so that's why sort of early stage investors will look for the ability that they know that no matter how much they get diluted, like there's still a chance they can get 10x, right? So that's why they take such a big chunk early on, because they're taking 50% now, but they know at the end they're going to end up with 10%. And how much can your company sell for? They're putting in $10 million and they want a 10x return. Can your company sell for $100 million, right? Because that's, for $1 billion so that they can get $100 million, right?
And what Jen said about as a founder getting diluted, it sounds scary from the outset, but it's going to happen. There are only so many, like Instagram is something a lot of people use every day of the week, and they only made $1 billion. But in life sciences, you can make 3 or 4 or 5 or 6 or $7 billion when you even IPO or when you sell the company. But to get there, especially if you're developing a new drug, it would take $250, $300, $400 million. So I represented a company last year that has a market cap today of $2 billion. When they started, the founders each had 25 or 30% each. When we filed for their IPO last year, they were down to 1% each, right? But they had 1% of a $2 billion company. And the investors have to be made whole for the fact that they've already applied, $300 or $400 million in. So you shouldn't be scared about getting diluted because it really is bringing in value. It's helping you make a drug or a technology that's going to be worth so much money that a percent of that is huge. And then just think about, as Jen said, the more money that comes in the door, the more valuable the company is, and hopefully the better chance you have of creating a great product.
Does that make sense?
I was just going to ask a question about redemption rights. Is it something are there rules about when a company can choose to exercise it? Like in terms of if a company's doing poorly, the startup's doing poorly, and then all of a sudden someone comes to you and says, actually, I want my money back? Or does the company have to be profitable in some way? Is there a way to regulate that, or is it just used so rarely that it's not often thought about?
So, basically they can't bankrupt you. So if you only have, if you only have 450,000 on the balance sheet and they wanted their 500,000 back, they can't do that. But the answer is yes. If you're going to stay in the black and they can take their money out, most of the time they can just walk in, knock on your door and say, I want my money back.
It usually comes when there's so it's very rarely actually exercised, but the threat is when there's a real divergence in terms of what the founder wants to do, because the founder has a lottery ticket to keep proceeding with the technology, and the VC wants to sell, right? So the VC's put in 10 million, and you're down to 2 million, right? The VC is incentivized to, because they're going to get their 10 million first, is to find a buyer to spend that $2 million to just maintain and sell for 10 million and take their money off the table with you having zero. Your incentive as the founder is to spend that 2 million and pray you hit on something, right? Because you're going to have zero either way. And so you have a disconnect in motivations, right? And so the VC comes and says, look, you have to sell. Like, if you can't raise money, I'll give you another 60 days. You don't raise money, you have to sell. Otherwise, I want to take the rest of my money out because you've already lost 8 million and I think you're going to lose 2 more, right? And so that's sort of extreme, but you can sort of see the context where it could be useful. It's not just the normal, you're doing great and, you're, 6 weeks away from FDA approval and this, and all of a sudden they're like, hey, I'd like my money back, right? Because honestly, what has arisen to address that, which is less common in life sciences because of, mainly because of insider trading issues, is the secondary market. right? So if they just want liquidity and the company is doing well, someone will buy their stock, right? I mean, there's someone in in America who will make money, who will take risks, right? That's what our financial system is built on. And so what ends up happening is if you're that 6 weeks below, away from FDA approval and they want to de-risk and they want to get out, what you do is find a buyer, but they don't necessarily make a company to get out. So that's why it's a lot less scary
than it sounds. Founders, when they first hear about it, it's probably the term that gives them the most concern, and like us, the least consternation. Whereas like participating preferred, a lot of times founders don't even care about, or they say, oh, they want a 3 times liquidation preference for participating preferred. And I'm like, no, that's terrible. And they're like, oh, that didn't sound so bad. They get 3 times their money back, right? And you're like, no, that's really taking money out of your pocket, and this is why. And so, exactly, yes. Yeah, and so and those are terms that are way worse for you. So, and that's what we're trying to say, is that redemption sounds very scary, but in reality, it you don't have to worry about it that much. So.
I think if anyone ever does threaten to exercise redemption rights, please call us. It's an interesting hypothetical.
Yeah, it'd be great.
But also, then I would throw a tantrum, and I would threaten to call everyone you've ever met in the scientific community and tell them that this VC is awful, and I'm pretty sure they'll back down. Right? They have a hammer, but reputation risk is huge because they want good founders to come to them. If they're known as the draconian venture capital firm, I mean, you're going to be the port of last call for the worst of companies.
Yeah, no, at that point it'll be a very exciting legal fight. You'll have fiduciary duties and this. It'll be a lawyer's field day. Oops.
Which is exciting for us, but no.
I know, yeah, that sounds so exciting, doesn't it?
So certificate of incorporation, continue with director voting rights. This is basically that the directors are going to be on the board, right? So when they invest, they want to have some say in how the company's run, and it's also they want to be able to continually monitor how it's run. So a lot of times they'll be on the board, and they guarantee themselves a seat on the board through this. Sometimes you'll see that some investors don't want to be on the board, and actually that's sometimes worse for you because they don't have what are known as fiduciary duties. Instead, what they'll do is they'll get these rights that they have all the information, they can sit in your board meetings, but they don't owe the company anything. You want them to be board members if they're going to be in the board meetings, because then they can't be sharing the information. They are beholden to do certain things in the best interest of the company. And so you actually, it's funny, you actually want them to be on the board, or you want them not to be anywhere near your board meetings. It's binary. You don't want to go the halfway because they have all the benefits and none of the burdens that are protected. And sure, you can enter into agreements that protect the information, they won't use it, but it's still in their brain, and subconsciously, if not consciously, they can still help other future investments or potential competitors because they're not disbarred from that. Whereas if they are on your board, they can be disbarred from helping competitors and from sharing this information. Protected provisions, these are basically things the company can and cannot do without that director's vote. Director's vote. Things the company cannot do without the vote of the class of shares, right? So you bring in one investor for $1 million as Series A, and tomorrow you want to liquidate the company, or tomorrow you want to put a ton more options into your option pool. You can't do that without going back to the investors and saying, can I do this? And they'll give you permission. If you have a number of investors, let's say you have 3 Series A investors, which would be a nice position, you can, the terms will say that you don't have to get all of their consent, you have to get 2 of their consent. You basically have to get a majority of your investors to consent to do these things, and it's a way of protecting themselves. And I think these are the protection provisions that make the most sense, right? Like they want to limit what you can and can't do, and it's basically you have to seek their permission to make fundamental changes at the company level. Optional conversion, mandatory conversion. This is basically their right to change their preferred stock into common stock. I don't know, it's kind of a dry area there.
Yeah. Optional conversion just means that they can always convert so that you know that they always get upside, right? So again, like if you don't have this participating preferred, if they put in 10 million, they get their 10 million back unless they convert, and it's all just baked in mechanically. And the mandatory conversion is one is just mechanical at an IPO. The other is upon a class vote, was actually interesting. That's actually something very useful for companies if you ever go in a down round. I actually just on Saturday was talking to a founder who was willing to sort of take that out. I'm like, no, it's actually very good for the company, believe it or not. So if your company, you know, in this example where you've given away 50% of your company for $10 million, and then you need to raise your next round at $5 million, and some of the guys from the 10 million round aren't excited about that, you know, especially the smaller investors, because they're just not going to put in money. So, you know, let's say they own 2 of that 10 million and the other 8 million, you know, knows that you need to take this sort of punitive action. Sometimes what they'll do, and they're willing to put in more money, is they'll actually vote to convert that preferred stock down to common. And so it's a useful tool in down rounds and in recapitalizations and structurings to get rid of, you know, bad VC terms. And so it's in there, and it's sort of just an interesting little side note. That's really where it's used. So even though people think it's just mechanical, I've actually used that one at least twice that I can think of right now as a term to cram down. So not you know, things go up and down. One of those companies is on the upswing. The other one I still think is going down. But
so then we're going to move on to other agreements away from the certificate of incorporation. Slide 8. So along with the stock purchase agreement and the certificate of incorporation that we've already spoken about, there are 3 other agreements that are important to the transaction that you always see. They are the investor rights agreement, the voting agreement, and the right of first refusal and co-sale agreement. We take them in order. The investors' rights agreement is exactly what it says in the tin. It is where all these other rights that the investors want that aren't, you know, totally fundamental, although 1 or 2 of them are, they're not like so fundamental that they need to be in the certificate of incorporation. They put them in this agreement here called the investor rights agreement. Out of all the agreements, this one probably survives the longest with the certificate of incorporation. What you'll find in the investor rights agreement is information rights, so that you have to give your investors a full report and audited financials yearly, you know, after every quarter, and these are points you'll negotiate, but basically it's to keep the investors apprised of what's going on in the company. One of the more important rights that they'll have are registration rights, and these are normally great for you if you're a company that these are being, that these are being talked about. It's basically the right they have to register your company and go public, and then after you're public, it's rights they have to make sure they can keep reselling their shares, and you'll sell their shares in the open market. Rarely are these rights actually exercised. It's a hammer. They'll say, we want to sell, and we'll say, yeah, that makes sense. Let's go and sell. Let's go and have an IPO. And you know that it's going to happen because the company is in the right position. Rarely are they saying, like, if you don't go and do an IPO, I'm going to make you do the IPO. Normally, if they're saying that, there's some weird mismatch because the market has to be ready to buy your shares anyway to have an IPO. And so it's more of a hammer than it's actually ever used. And the same for the resale rights. Normally you'll say, hey, I have these rights, but can we go and do another offering where you sell my shares instead of you sell company shares, and you won't stick to the letter of the agreement. You might do something else, but behind all of that is that they know that if you wanted to, as an investor, if you wanted to force the company to sell your shares, you could. So normally it's a good thing that you're talking about these rights and that they're in place. Your company's been successful, and you're doing an IPO where you sell company shares, and then later on you're doing another offering where you're selling their shares. The other interesting rights in the IRA are, I guess, information rights we've already covered. Basically what Jen already spoke about, which is their pro rata right, their preemptive right. That is that if you go and do another if you go and do another sale of preferred stock, you're doing your Series B round, that the investor has the opportunity to participate again, right? I own 20% of your company, you're going to go sell another 1 million shares, I get pro rata participation rights, I get to sell in your offering again, up to the same percentage that I already hold. And that's how they protect their investment, basically, right? Instead of getting diluted, they can come back to the table again and they can sell more shares. They re-up, they keep their 20% in the company, The next agreement is the voting agreement. Basically, it's another agreement that protects the investors. It's that you will always vote your shares to make sure that the investor has a seat on the board. And the other interesting one is the dry law. Basically, if the investors decide that they are going to sell the company and you decide you're going to sell the company and there are certain shareholders who might want to vote their shares for a sale and you need their vote, that they are required to vote their shares for a sale. So it's a drag along, you drag them along with you and everyone agrees to sell. And it's the way the investors can get out if there's enough momentum to actually have a sale, no one can block it. And then the right of first refusal and co-sale agreement, it's kind of an interesting point, and it's kind of like your restricted stock agreement that, you know, if you have a form restricted stock agreement, you can't sell your shares outside of the company before you offer them back to the company. This here is the same thing. The investors can't bring in a new investor before they offer their shares first to the company, and if the company has the money to buy the shares back from the investor, it can. But normally the company will say, no, we don't want to use our money to buy your shares back. If you're an investor and there are other investors, you have to offer your shares to the other investors at the price someone else is willing to pay. And it's a way to make sure that you're happy with who's within the company. And not only does this tie down investors, they normally will have the founders sign it too, because they don't want founders getting out. They don't want founders selling without first, being willing to sell back into the company. So that's the right of first refusal. It is what it says it is. The co-sale is interesting too. It's that if we're all investors together, we all, put $1 million up. There are three of us, so we've all, put our $3 million up. We've all taken the same risk. If in a year I decide I want to sell my shares to somebody, I can't sell all my shares if I get an offer. And if the company doesn't buy them, and I get the outside offer, I have to offer them to the company doesn't buy them, I offer them to the other shareholders, the other shareholders say no, that doesn't automatically mean I can sell them to the outside, all of them. But the co-sale agreement is that I can sell a portion of mine, but Jen and any other investor gets to also piggyback on the sale, right? So if I get someone to buy my 1 million shares, and I have 2 other investors who have 1 million shares, I can sell 333,000, and the other investors can also sell 333,000. It makes everyone's risk profile the same. One can't get out without everyone else getting out for the same proportion, and it kind of just equalizes it among the shareholders. I've actually seen this recently in an M&A deal, and it's an administrative nightmare. Rarely do you see these exercises, but when they are, it's not a lot of fun. Just because you have to go through unwieldy notice provisions, I have to tell the company, I have to wait 10 days, I have to tell the shareholders, I have to wait 10 days, I have to tell the outside, I have to wait 10 days. And it's a dance that you probably don't end up doing, but when you do, it's not a lot of fun.
Yeah, these are sometimes called tag-along rights, just so you know. So sometimes they're called drag and tag, and they go together. For some reason, over time, people decide to call them co-sale rights. But so those are really the terms. I don't know if we want to pause here. People have any other questions before we go on? I don't know. We're a little over time right now. Is that right? Is that? Okay. I mean, should we go a little bit, or
we can try to do questions.
Yeah. Do you guys have any more questions at this time about what? So why don't we pick out, a couple of the high level trends. I guess these are really just it's these 5 trends here. We could just talk about a little bit and then see if people have some questions. We provide a lot of detail, but it's really just this first slide that talks about the trends we're seeing.
So,
yep.
Go back to page 8 on PowerPoint presentation. And you mentioned key areas. Is there a difference between just holder of stock versus key holders?
It's the founders, it's the people that are integral to the company. So you can have anyone over 1%, because assuming they have over 1%, there's something they brought to the company, their employees or their founders. So they bind those all to the same agreement, so they can't get out without everyone else getting out, basically. That's what a key holder is. So a normal stockholder isn't necessarily a key holder, you're kind of a key holder at the election of the investors. And it's the way they protect themselves. one thing to note is that if you do end up doing a Series A round, and let's say you do it with someone who's not as sophisticated, or you have an investor who, it's their first time, or for some reason you're someone willing to write you a big check. If you decide to do away with all of the process that's in here, and you want to, you guys invent terms, you do something a little different that's not market, that's fine and well and good for the first 6 months. But when you need more money, you'll end up unwinding it. So although some of these terms are annoying, at times it's worthwhile going with what the market is, so you don't have to spend more money later unwinding to bring in other people. You kind of want to be fungible, isn't the right word, but you want to make sure that you're not scary to investors. If you get good early seed investors that want to do this, you don't want to throw away the book. You want to make sure that you look marketable to the next set of investors, and that their terms they've seen and that they understand.
Yeah, that's a very important point. I mean, I think we talked about originally sort of being simplicity is better, efficiency is actually a goal, and the way to think about this is it's a fine balancing act. What you're doing at each level is sort of building the foundation. And on one hand, if you think about a house, right, you want to build the foundation of the house for the right size house, right? And some people tend to say, I'm going to sort of piece it together, and this is going to be super creative, and it's almost like a house of cards, right? It's so fragile, and it only works, and there's no ability to expand. And then other people go the other way, and they're basically like, try to build a foundation like for the Freedom Tower, right? Like that it's so complex, and so every variable is thought of so that no matter what, everything could just sort of like pile on top. And what you can do is sort of say you really want to be in the middle. Like, how much money do you need? What are you going to do? What's the the 80-20 rule is very important here. What are the 20% of the scenarios that are 80%, they're going to take up 80% of the time, and don't worry about the margins. And so that really is how you can help, we can sort of help you do things. So for example, just going back to redemption rights, there's little bits that you can do to change that, right? But don't spend so much time either, piecing it together so that you can't build that the next investor's like, I have no idea what that means, or that you have every scenario plotted out, right? So that no matter what happens, in year 7, this happens and this, and right? I mean, that's also a waste of time. Like at a certain point, you have your foundation, you know that you can grow as you want, and if you need to, you can always add on an extension, right? You can always change it a little bit, but that it's not fragile. And that is hard sometimes for founders. There's a little bit of rough justice, there's a little bit of unknown, there's a little bit that it may go your way or may not. It may be that you have a little more, some more legal fees, and ideally down the road. But in general, there's sort of down the middle of the fairway is a way to play it within, certain parameters.
And the same goes for the amount of time it takes you to do
exactly
the round. Like every day you waste talking to me and talking to your potential investors is time away from your product. It's time you should be spending in the lab working on a new discovery. It's a waste of your time, right? This should be somewhat seamless. It's been done hundreds and thousands of times. And it shouldn't be a case that you're over negotiating your terms. You don't need to be Warren Buffett right now. You can be later. If you want to sell your company later on to Merck or Regeneron or take any of these great names, that's the time to be the hard ass in negotiating. Now is the time you kind of want to go along to get along, because you need to get back and focus on your product. Because at the end of the day, you're just costing yourself time, and the money is better used tomorrow than it is in a week.
right.
And the same goes for your investors too, though. If they are hard-assing and negotiating every small point, you can only imagine what they're going to be like in your board. So it's a great way to diligence your investors as much as they're looking at you.
Right, and it's time to really be decisive. I think what we're able to do is say, here's the trade-off, right? You can have this or this. You can have their money or not have their money. This, what are the other things? And then you just really, you spend a certain amount of time. Those are all the factors, and then you just make a decision and move on. And that's, that's sort of one of the key things. Just in talking about the trends, I mean, just very quickly is, we do see a little more founder leverage, even for life sciences, again, that trickle down from, and then there are slides in the back that you can just read yourself, but I'll just sort of speak a little extemporaneously. Even in life sciences, I know tech gets all the glory recently, but I mean, this 2013 was the best life sciences IPO market in a decade, seriously. So that trickles down, right? That means people are excited about life sciences. There are really successful life sciences company in New York. This is like an exciting time to be here. It's an exciting time to be at Harlem Biospace in particular, but just in the city in general. And so that does give you a little bit more leverage than you may have, in 2006, honestly, as a life sciences company trying to raise money. There's more focus on the key provisions. Everybody in New York has focused a little bit more on these are the important provisions. New York historically has been a bit more of like negotiated terms, like a Boston-y style. The West Coast is very big picture, right? That's what they're known for. What's happened over time is that the West Coast has proven that they make more money than Boston. And so New York is like, yep, we like that way better, right? And that's really what I've seen happen in this market is they're like, okay, New Yorkers really don't care. They don't have like a moral judgment as to which terms are better. They just want to make the most money. And California has just proven that, their way is better. So that's what we're seeing here is a huge influence by that. More acceptance of founder liquidity terms. What that means is that as time goes on, if you're getting very, extremely high valuations, founders are able to take money off the table earlier so that they're de-risked. That's less common in life sciences because, again, it's a little bit more binary. So if you're in healthcare tech or med device that has a more marketing component, then potentially this will play in. But if you're in a pure like FDA, FDA approval, yes, you get a skyrocket valuation, FDA evaluation, no, you don't get one. That tends to not allow founders to take as much money off the table. But I know there's sort of a mixture of companies here that some were doing other types of life sciences. And then significant founder investment at the outset, again, if you are self-funding, and by that I mean not just sort of not having a job or not just sort of $10,000, but to the tune of $50,000 or $100,000. And I think we talked about this early on. Or even more than that, $1 million or whatever. But even to sort of a significant 100,000, 200,000, we are seeing founders structure that to be more like preferred stock so that they have a better seat at the table and not just putting that in as common stock. And that is one thing that we're seeing, especially as people are doing multiple rounds of companies, right? They've sold one, starting again, or co-founding, science and hedge fund guy, right? So where someone has money. And those are sort of the overall trends. Yes, yeah?
So I know it's impossible to predict the biotech windows, how long it'll be open
Yep.
and such, but if and when the window ever changes in the near future, how quickly does that trickling down effect take place to the early stage companies? Be it everybody's enthusiasm or how strong is that correlation?
I think it's going to lag, right? Because a lot of these VCs are making money and have made money. IPOs are big exit for VCs, and I see a lot of them are doing follow offerings, so they're just taking money off the table, and that's money they're going to end up giving out to their investors. But it also makes them look better, so people want to redouble their money. They might get in the fund, but it's just more capital that gets played with. So even if the market takes a downturn in the next few weeks, there's been a lot of success for these VC funds. They look good. I can't imagine it's going to be immediate because there's going to be money slushing around the funds. It's made at the top level, but then it goes down and then needs to get reinvested or given back to the investors in the VC funds.
Yeah, I agree. I think the issue where it would really be the cramp down is if, which would be surprising after this sort of run up, is if the funds can't actually raise the next fund, right? So this money is all going back out to LPs, and so VCs are now going to start, and they are raising their next funds, right? And those will probably be bigger or at least the same size, and they will have that money to invest. If for some reason that is a more constricted market than expected, then you could potentially see a tightening up of terms sooner. There is always a bit of a lag. What's interesting is that these IPOs will have a currency. They will provide exits for some of the smaller companies, right? Like, really, you just need exits, and IPOs is just one of it, right? One of the exits. And so, as long as you have a robust M&A market, which will potentially be after this, I think you'll see quite a while decent terms for founders. I agree with Dara. I think 2014 is a great year to raise money for a life sciences company. So let's put it that way. I mean, 2015, I'm not sure, but 2013 was super strong. We still have many companies, believe it or not, still preparing S1s like now, to go public, right? So that they're starting now, so people don't think that we're at the end. And you're now at the companies, like if you didn't go in 2013, you're a company that was like behind. If you were at all ready, you went in 2013 and you were life sciences, right? I mean, it was unbelievable, sort of the, outpouring of IPOs.
The thing is as well, and caveat that we're lawyers and not investors, or VCs, I feel like Richard for the was, but the FDA has approved more drugs last year than it ever has before, and hopefully I think that was the statistic I heard from some economists, and if it does it again next year, that's just more success, that's more money. I think the market might dry up just because there aren't, anyone who was good went into last year, so you won't see as many biotechs going public, because they're just not ready, some of them, to be frank, but I don't think that means that just because you are seeing as many IPOs, there isn't as much appetite for risk lower down.
Yeah, I think there's a lot of good science out there that people are now willing to take the risk to commercialize. So you hadn't seen that. So you're seeing, more folks like you, who are willing to say, I'm going to go and try to build a company out of a technology. And so all of that helps. So raise money this year.